Mangalam, these are the earnings reaction. To watch today, there is a lot on the consumption plate.
Yep, you are looking at Nestle. The stock was doing well in yesterday's session, but importantly, it's 10% away from its 52-week high, trading at 60 times, 62 times, so to say, but not much expected from this quarter's performance. All eyes on the next quarter's performance. So revenue up 3.5%, 5,300 crore thereabouts is what the street is working with this time around. EBITDA largely flat, which implies a margin decline of almost 100 basis points, 22% versus 22.9%. And the net profit on an optical basis declines by 28% because remember, there was a one-off gain in the base quarter. What is more important to look at this time around is the absolute performance. Out there, you're looking at anywhere between 700 to 710 crores on the bottom line. The impact of GST-led trade transition would be anywhere between 350 to 400 basis points. So had it not been for the GST rate cut, you could have seen a revenue growth anywhere between 7 to 7.5%. 3 to 4% growth in their domestic business, 7 to 10% growth seen in exports, domestic volume seen between 1 to 2%, and 80 to 100 basis points impact on account of higher prices for some of their key raw materials, which include the likes of milk, coffee, and cocoa. More importantly, trajectory on growth in their pet care business, demand post GST, and strategy from the new leader, Manish, who takes over from Suresh Narayanan. The other one, which we're looking at, is Eternal. More importantly, here too, the commentary on competition for both food delivery as well as quick commerce will be extremely crucial. But year on year, these numbers are likely to be very strong. Revenue growth of almost 66%. EBITDA grows much lower than the revenue at 13%, which implies margin compression. But that's largely expected because of the strong expansion that the company has been doing on their quick commerce front. And as a result of which, there'll be a decline of 21% in the net profit. Nothing really to worry about here because a large part of that decline would be on account of higher depreciation. What the company has to say on food delivery, GOV, and the outlook for margins or reduction of losses in quick commerce would be the ones that would drive the stock from here.
Okay.